Welcome to the Deep Dive, where we cut through the noise and get straight to the essential insights from the latest earnings calls. Today, we're diving deep into the half-year 2025 interim results for Qatar National Bank, or QNBK, a true giant in Garth banking room, spanning everything from retail and corporate to, well, international finance.
Absolutely. And our mission here is really to take you beyond just the headlines. We want to give you a crisp, clear understanding of what actually happened on their earnings call, what those numbers really signify, and, the broader context for investors like you. We'll be pulling out the key takeaways from the results, management's comments, and importantly, how the market reacted initially.
Okay, so QNBK released these results before the market opened on July 9th, 2025. The call kicked off pretty soon after. And what we saw was, well, a modest beat on their headline numbers, but interestingly, the market kind of took a wait-and-see stance. Let's try and unpack that a bit. So kicking things off with the top-line numbers. QNBK reported group revenue climbing 6% year over year. That's QAR 8.21 billion. Now, that's not just a number in isolation. It actually came in about 5% above the QAR 7.8 billion consensus analysts were looking for. So a pretty decent beat on revenue right away.
Right. And on the profitability front, EPS, that's earnings per share, came in at QAR 0.42. That just edged past the QAR 0.41 the street was expecting. What's particularly noteworthy, I think, for a bank this size is their operating income margin held strong, really sturdy at 47%. That points to some impressive efficiency.
And for those of you watching Dividends, the bank also surprised with a 35% interim cash dividend. That's actually their second straight year doing a mid-year payout. Does that signal confidence, or was it sort of expected?
Well, it certainly signals balance sheet resilience, no doubt about that. But our read is that this interim dividend was largely telegraphed, maybe priced in already. So while the revenue and EPS beat were welcome, the market's reaction suggested that things like the inline guidance and that expected dividend, they didn't really provide any fresh catalyst. That's likely why, despite solid figures overall, the initial stock reaction was pretty muted.
Okay, right. So beyond these headlines, let's dig a bit deeper. What were the standout details in their financial report, and what did management really emphasize on the call?
Okay, so from a deeper financial perspective, QNBK reported a net profit of QAR 8.4 billion. That's about $2.3 billion US. Now, on the surface, that's up 3% compared to last year. But here's a really crucial detail. This growth was partially hit by the new global minimum taxes. People often call them Pillar 2 taxes. They just became effective in 2025. And it's this complex international framework, basically making sure big multinationals pay a minimum tax level. So if you actually exclude the impact of these new taxes on a like-for-like basis, net profits surged by a much more impressive 11%.
Okay. So that 3% reported growth doesn't tell the whole story then.
Exactly. And operating income, meanwhile, saw an 8% increase. That reached QAR 21.8 billion, or $6 billion. That shows pretty broad growth across their different revenue streams.
And their efficiency, you mentioned the margin, but the cost-to-income ratio itself, still strong.
Yeah, incredibly strong. It remained robust at 23%. And just for context, that positions them as one of the best among large financial institutions right across the Middle East and Africa. They're just, really good at controlling costs relative to income.
Okay, let's look at the balance sheet. How's that shaping up?
Healthy growth there, too. Total assets grew by 7% from the same time last year, hitting QAR 1.354 trillion. That's $372 billion. Loans and advances also saw a significant jump, up 9% to QAR 962 billion. Or $264 billion. And they were successful in attracting deposits, too. Customer funding increased by 5%, reaching QAR 935 billion, or $257 billion. Their regulatory loan-to-deposit ratio, which is a key liquidity measure, stayed stable at 96.6%. So what these numbers really tell you is a story of robust expansion. They're growing the core business effectively while keeping funding strong.
And asset quality, always critical for a bank. How are the non-performing loans looking?
Still a major strength for QNBK. The ratio of non-performing loans, NPLs, those loans at risk to gross loans held stable, very low at 2.9%. This really reflects a high-quality loan book and, frankly, effective credit risk management, plus their coverage ratio on Stage 3 loans. That's basically the bank's reserves against its riskiest loans. That sits at a healthy 100%, strong provisioning there.
Right, well covered. And the capital position?
Very comfortable. Total equity expanded by 8% to QAR 119 billion. And the bank's capital adequacy ratio is high, 19.2%. That's well above both the Qatar Central Bank and the international Basel III requirements. They have a solid buffer.
Okay. And did management mention anything about their share buyback program?
They did give an update. They've completed buying back about 116.1 million shares. That cost QAR $1.96 billion up to the end of June 2025. And the buyback is still ongoing. Importantly, they clarified on the call that right now they have no plans to sell these shares back into the market. Given their strong capital position and apparently current rules make canceling them restrictive, they just intend to hold on to them, which, signals management's confidence in the bank's own value.
Definitely. Okay, so these operational trends, they don't happen in a vacuum, right? They're shaped by the wider economy.
Sure.
What did QNB's own treasury team say about the macro picture and their outlook?
Yeah, Mark Abraham from their Treasury team gave a rundown. He painted a picture of the global economy expanding about 2.8% in 2025. That's slightly lower than last year and just a touch below its long-term trend. He noted continued volatility, things like U.S. policy uncertainties, geopolitical dynamics. That's still out there. But he also highlighted that central banks in advanced economies have already front-loaded quite a bit of monetary easing, and more is expected through the second half of this year and into 2026.
And closer to home, the Middle East region.
There's a sense of easing geopolitical tensions, apparently. They specifically mentioned an Iran-Israel ceasefire on the call, and moderate oil and gas prices are continuing to support substantial revenues across the GCC, the Gulf Cooperation Council. That's leading to twin surpluses, fiscal and current account, or it's funding these large investment projects. Combine that with structural reforms and expanding international tourism, and it's adding some real momentum to the regional economy.
Okay, and drilling down specifically into Qatar, what's the domestic picture?
Quite positive, actually. Robust fiscal and current account positions. Domestic activity has been strong. Non-hydrocarbon GDP, that's the economy excluding oil and gas, grew by 3.4% in 2024, driven by dynamic sectors like wholesale, retail, accommodation, food services, financial services. And the preliminary data for Q1 2025 suggests that strength is continuing. Non-hydrocarbon GDP expanded by an even stronger 5.3% year over year in Q1.
Wow. And there's this massive Northfield expansion project, too. That seems like a huge long-term driver for Qatar and, by extension, for QNBK.
Oh, absolutely. This includes 8 new LNG trains. It's one of the largest capital expenditure projects anywhere in the region. It's expected to boost Qatar's energy production by a staggering 85%, up to 142 million tons per annum by 2030.
85% increase. That's enormous. What kind of economic impact are we really talking about here?
Well, that's the real story underpinning things, right? These investments, combined with their diversification efforts, they're projected to keep Qatar's GDP growth strong, accelerating to 4% in 2025, then 5.2% in 2026, and a really robust 7.9% projected for 2027. We're talking about a potential multi-year economic boom, and QNBK, as the national banking champion, is just perfectly positioned to capitalize on that.
Right. So with that powerful macro backdrop, what does this mean for QNB's actual operational guidance? Did they update it?
They did. CEO Abdullah Mubarak Al Khalifa highlighted accelerating loan demand, particularly across GCC markets. And reflecting that, the bank actually upgraded its full-year guidance for loan growth. They bumped it up from 5.7% previously to a new range of 7.9%. Deposit growth guidance was also up slightly from 5.7% to 6.8%. And asset growth guidance moved from 5.7% up to 6.8% as well. So that clearly signals management's strong confidence in their ability to capture that accelerating demand they're seeing.
Okay. Upgrades across the board on the balance sheet side. What about profitability guidance, especially factoring in those Pillar 2 taxes and potential rate cuts down the line?
The CFO reaffirmed their full-year profit growth guidance, still targeting mid-single-digit growth overall. They stated that international expansion should help offset some of the drag on net interest income if or when rates get cut. Profit before the impact of Pillar 2 taxes is still expected to be in the 10-12% range. But profit after those Pillar 2 taxes hits, the guidance remains 1-3%. So you see that big tax impact clearly. The cost of risk guidance, their estimate for loan losses, remains steady at 80-85 basis points, shows consistent risk management expectations.
Okay, interesting. Let's get into some specifics from the call. Where did that Q2 loan growth actually come from?
A significant chunk came from international markets. Almost half was apparently from Turkey, followed by their other divisions. They mentioned Saudi Arabia contributed, but not in large numbers was the phrase used, which might be a bit surprising to some listeners.
Turkey leading the growth. Interesting. How's the asset quality holding up in those international segments, especially somewhere like Turkey with its, challenging rate environment?
Yeah, good question. Turkey did see NPL's non-performing loans deteriorate a bit. They went from 2.5% in December up to 3.2% in June. Management put that down primarily to the high benchmark rates there. They expect NPLs in Turkey to peak around 3.5% though, as they anticipate rates becoming more accommodated in the second half of the year. Conversely, in Egypt, NPLs actually improved, dropped from 5.3% in December down to 5.1% in June, and they expect inflation to peak there too. So, despite these regional variations, QNB's overall cost of risk guidance remains consistent. They seem to have built-in provisions to handle this, showing discipline even in volatile spots.
Right. And what about funding? They mentioned deposits were up. Any color on where those deposits are coming from?
The increase in non-Qatari deposits, they said, is really just a function of liquidity needs, cost, and pricing. Standard banking practice. They did indicate a preference, though. QNB prefers longer duration non-resident deposits, typically over 1 year and ideally over 2 years. So that suggests a strategic focus on getting stable long-term funding locked in.
Makes sense. Let's talk net interest margin, or NIM. You mentioned rate environments affecting things. How did NIM perform in Q2 and what's the outlook?
NIM in Q2 was slightly lower than Q1, primarily due to those developments in Turkey, actually. There was a late Q1 rate hike there, which squeezed their margins a bit in the following quarter. However, as they expect Turkey's rates to become more accommodative, QNB anticipates a recovery in NIMs there. And because of that, they're sticking to their overall group NIM guidance of 260 to 265 basis points for the full year. As for Fed or Qatar Central Bank rate cuts, they anticipate the main impact wouldn't really be felt until 2026, or maybe very late in 2025.
Okay, so NIM holding steady despite some regional pressures.
Yeah.
What about costs? Operating expenses, OPEX. Where's the growth coming from there?
Well, within Qatar operations, they typically see a maximum increase of maybe 5-6%. Pretty controlled. However, most of the OPEX growth for the group is coming from Turkey and Egypt. That's mainly due to their historically, extremely high inflation rates, although management noted these are now starting to moderate. Consequently, the group-level OPEX growth will naturally be higher than just the Qatar-specific figure. It reflects high single-digit growth in those big international franchises due to inflation pass-through.
Got it. And their diversification strategy, they aim for 50-50 international domestic earnings, right? How are they progressing on that?
Yeah, that's the long-term aim, 50-50. They acknowledge they're currently below that target. But despite that, overall profitability has continued to grow consistently year after year. Their plan is to improve that diversification, but at a measured pace, focusing on sustainable investments in their current international operations, rather than splashy new acquisitions, perhaps.
Okay, and one last detail, contingent liabilities. Things like letters of credit, how do they trend?
Those grew about 9% year to date. That's actually slightly higher than their loan growth. Management explained this growth reflects the carries fees associated with these off-balance sheet items. And those fees contribute to their overall fee and commission income line, which also saw strong growth, about 10% year over year. So it's another healthy revenue stream that's growing nicely. So pulling it all together, what really stands out here is QNBK's strong underlying operational performance and the robust balance sheet, especially when you set it against this backdrop of pretty significant macroeconomic shifts like the new taxes, the upgraded guidance for loans, deposits, and assets. That clearly signals management's confidence. They believe they can capitalize on that accelerating demand, particularly in the GCC markets.
Right. But here's where it gets, perplexing maybe. Despite all these positives, the revenue beat, the upgraded guidance, the solid balance sheet, the market's reaction was just flat, muted. We saw only a tiny 0.1% uptick on the day, even though trading volume nearly doubled. That screams wait and see. It's almost like the market is saying, yeah, the underlying stuff is good, but show us the profit after these new taxes really bite. It suggests that while the beat was acknowledged, investors saw the inline profit guidance and the expected dividend as basically already priced in. No new catalyst there.
Exactly. This dynamic really throws the impact of those new Pillar 2 global minimum taxes into sharp relief. They're now hitting QNB's previously untaxed earnings in Qatar, which is a big part of their business. This significant tax headwind just explains why the reported profit growth, while still positive, is much lower than the underlying operational strength would suggest on its own. The market is clearly weighing this new tax reality against the strong balance sheet growth and that future potential from things like Northfield.
And it seems this was seen as very QNBK specific news, right? Not really moving the needle for other Qatari banks.
That's right. Pure Qatari lenders saw very little read across from QNBK's results. It suggests the market treated this news as company specific, not a sector-wide signal. And just for context for listeners, QNBK stock is actually up about 15% year to date. It's bumping up against the top end of its 52-week range. However, that upward momentum has been intermittently clipped by other factors, things like thin foreign ownership caps, maybe some geopolitical tariff chatter. It keeps putting a bit of a lid on a more enthusiastic breakout.
So connecting this to the bigger picture,
Yeah, the long-term growth story for Qatar itself, especially that massive North Field expansion project we discussed, that provides a really compelling backdrop for QNBK. While the short-term market reaction reflects this cautious approach, understandable given the new tax impacts and international complexities like Turkey, the underlying pipeline of capital expenditure in Qatar and the bank's disciplined approach to asset quality, even in those volatile regions, it really underscores a resilient and strategically positioned institution for the long haul, I think.
all right, this is Talk Tickers, and now it's time for our This Is Not Financial Advice segment. Remember, these are just ideas strictly for entertainment purposes that we think are perhaps outrageously plausible. What have you got for us today?
Okay, so given QNBK's H1 results, that muted market response we just talked about, despite the upgraded balance sheet guidance, despite that massive long-term domestic tailwind from Northfield, I'm thinking about a multi-year deep value long position.
Interesting. So you're basically saying ignore the short-term noise, forget the current market psychology.
Precisely. Look, this is a bet on the long game. The market right now seems hyper-focused on near-term things, potential rate cut impacts, the immediate hit from Pillar 2 taxes. And those are valid concerns for quarterly reporting, sure. But what's truly fascinating here is the sheer scale of that Northfield expansion project. Remember, we're talking about an 85% increase in Qatar's energy production by 2030. That's projected to drive GDP growth towards almost 8% by 2027. That's a generational infrastructure build-out.
That is a truly massive amount of economic activity flowing through the system. But how tied is that purely to Northfield? What if energy prices, say, soften significantly? Does that derail the whole thesis?
Well, energy prices are always a factor, naturally. But the diversified nature of Qatar's investments now, the structural reforms, they provide some resilience. And QNBK, as a national champion bank, is just inextricably linked to all this activity. They even confirmed on the call that the spending is already showing up in their contingent liabilities and indirectly on the balance sheet growth. So the outrageous part of this idea is deliberately ignoring the short-term wait-and-see market sentiment, ignoring the current friction from things like foreign ownership caps or geopolitical chatter. The plausible part is that these feel like temporary blips, especially when you weigh them against a national mega project that is set to drive consistent, high-quality loan growth and fee income for QNBK for years to come.
Okay, so the core idea boiled down is buy the dominant bank that's fundamentally tied to a national mega project success and strategically look past the quarterly tax adjustments and the market's current indecision.
It's really about betting on the long-term structural transformation of an entire economy and its primary financial engine, rather than getting caught up in the day-to-day or quarter-to-quarter trading psychology. I mean, look at management. They're buying back shares and holding them. That signals their belief in the intrinsic value over these short-term market fluctuations. It sort of reminds you of that old saying, doesn't it? Patience is a virtue, especially when the underlying fundamentals seem this strong for the long run.
Okay, and that wraps up our deep dive into QNBK's H1 2025 earnings call. We've covered their solid financial performance, the upgraded growth guidance, that balance sheet resilience, even as they navigate the pretty significant impact of new global minimum taxes and those international complexities, particularly in places like Turkey.
Yeah, the call really highlighted that robust macroeconomic backdrop in Qatar. Driven by these ambitious long-term projects like Northfield, they're set to fuel significant future growth for the bank, forming a really powerful counter-narrative, I think, to some of those short-term headwinds the market is focusing on.
So the question for you, the listener, is, what does this all mean for how you view QNBK? Given the clear long-term growth engines they've identified, how much of that short-term market sentiment, the noise around taxes and rates, are you willing to filter out when assessing its true longer-term potential?
Definitely something to ponder as you connect the dots yourself. Remember, the whole goal of these deep dives is just to equip you with the knowledge, the different pieces of the puzzle, so you can form your own informed perspectives.
We certainly hope this deep dive into QNBK's earnings has provided some valuable insights for you. Thanks for tuning in.